Thank you so much, Mr. Mahansaria, for agreeing to do this, making time. Uh, second time founders, it's a very honored thing also, given that, a founder who has seen liquidity already. So, thank you for agreeing to do this.
Thank you for having me.
Yeah. So, having gone through a cycle of birthing a company, you grew the company, then exited, saw a liquidity event. How do you see the entire experience?
Yeah. So look, I think, obviously when you start building something, exit is not on your mind, or it should not be on your mind, right? The focus should be on building a great business that can sustain over time. And frankly, when we started on our second journey in 2007, together with our partners at Warburg, that was exactly our focus, that how do we build a stronger business, a business that is more value additive than the first one, and so on. And we had a great journey over 10 years where we bought a company in Israel, then built plants in India, acquired something in the US, grew it to size and scale, and frankly, we weren't looking at an exit when we were approached by Yokohama, and they explained us their plans, and I said that after 10 years of significant private equity ownership, it was the right time to find a permanent home for the company. So I think certainly, when we started the journey, the intent had never been to exit. When the opportunity came, it looked like the right thing to do for the business, and we did what's right for the business. And I must say that Yokohama has been a good steward of that business, invested in it, maintained it, and so on and so forth. So I think it was a great journey, great learning, and of course, a little bit emotional when we sold it, but that's life. And because that happened in a fairly short period of time, the whole approach from Yokohama and the sale, didn't really have a concrete idea of what we are going to do next. So took some time, figured it out, then realized that what we had been doing, the off-road tires, still had a lot of potential in India. So once our non-compete was over, we decided to get back in the business.
Right. So in a sense, when you come back to the market, you come back with a sharper idea.
Absolutely. I mean, if you've done it before, you know the space well, you know where the opportunities are, what the things to watch out for are. But of course, since we had a 3-year non-compete, the market is dynamic and changes every day. So whilst you do have a general sense, you have to be careful that you recognize that markets have changed in the few years and take the effort to sort of bring yourself up to speed.
Right. Bringing up yourself to speed, I mean, that is very critical, given that, how first-time founders really struggle with what we now call PMF, the product market fit, or TAM. So having already built a successful business, I'm sure second-time founders are able to really build businesses at speed and scale.
Yeah, I think that especially if you are doing it in the same line, I think you can move a lot faster. Because as I said, you know what works, you know what doesn't work, and you just need to catch yourself up to speed for the last 2 or 3 years. Now, had we gone into a new line of business, I think we would have a longer learning curve, but certainly shorter than a first-time entrepreneur. I think, what I realized is that irrespective of the nature of business, many of the challenges that entrepreneurs face or management faces in a business is sector agnostic, whether it's finance, HR, etc. So I think the fact that you have done it before, if you're doing it again in the same line of business, invaluable. If you're going into a new line of business, your past experience will of course certainly help you.
Right. Past experience certainly helps, and we've realized when we talk to a lot of investors, there's clearly a bias towards second-time founders as well, right, from the investors' end. So that makes probably access to capital also easier. So do you think that second-time founders have it easy with the investors as well?
I think it's certainly an advantage because investors have seen your track record, they know what you are capable of, there's a lot of stuff they can relate to and reference to. So I think it's absolutely fair to say that it is easier. But having said that, every journey is a new journey, and investors are going to do their homework, look into it with depth. But yes, you do have an advantage, absolutely.
Right. And do you think that the second time you start up or a third time, are these businesses becoming more, are you trying to do more with little in terms of the kind of capital that goes in? Are these more efficient? Are the unit economics more stronger each time you start up?
So I would say that my approach always has been that in every go around, I've tried to think about what can we do differently than the first version, right? Where can we add value knowing what we do? So I would say the common anchor across our three innings have been leveraging India's cost advantage and engineering skill advantage in developing a wide product range and low cost manufacturing. So I would say that has been the common thread. In every go around, we've tried to become more sophisticated on the front end. So the first time round, it was basically producing in India, having an Indian sales force selling around the world, a classic low cost, value arbitrage, if you will. In the second go around, we acquired front end distribution in the US and saw how that really helped us grow significantly in the North American marketplace. And therefore we said, when we do it the third time round, let's replicate that on a wider scale. So we did acquisitions of distribution companies in Europe and the US very early into our third journey. So every time we've tried to kind of say that, what you don't change and where can you value add, right? I think on the question of capital, I actually think that, every time we started over, we've actually needed more capital because you want to get to scale faster, right? So we've actually thought about how do we build scale very quickly, and therefore that means you need more capital. But I would say certainly we've been able to be more capital efficient as opposed to absolute amount of capital. Every time we've needed more. But capital efficiency obviously improves with experience all the time.
So did you come back with a larger vision each time you started up?
I would say the second one was significantly larger than the first. I think we are trying to do significantly larger things than the second time around. Let's see. We're still very early in our third innings.
Right. And what has changed? Because you've seen two cycles, what has really changed for a serial entrepreneur like you?
So I would say that the world is much more international on the one hand. When I started off making and exporting farm tires in 1995, it was just, post-liberalization, the WTO was still in its early days. The whole concept of international trade was really developing. Today, I think we've been through a full cycle where the world has gone more global and is now becoming, on the other hand, a little more protectionist. I would say volatility is certainly to another level. Bharat and me were talking before the chat, and we were saying we don't know what's new normal anymore, right? You've seen COVID, you've seen shipping crises, you've seen Russia, Ukraine, Israel, you've seen Red Sea crisis. I mean, you name it. In 2019, if someone asked you, do you think the world can close down for a few months? I don't think any of us would have ever imagined it. So I think the volatility that one has to deal with is significantly greater than any time I've seen in my life. But I think on the positive side, what's changed is today, the acceptance of India. The acceptance of India as a reliable partner, the acceptance of India as a producer of high quality, competitive goods and service. I think these are significant changes on the positive side. Today you don't have to sell India as a supply source. Most countries around the world would accept that an Indian product is good, the quality is going to be better than, for example, China, and therefore you should be prepared to pay a little bit more, and that Indians are reliable trading partners. So I think these are some very fundamental changes we have seen on the positive side. And I think today it's fair to say the whole world is looking at what they can do more with India, which certainly helps.
Right. Also, Yogesh, having exited a company, you've made a lot of personal wealth. So we have seen that in the last 5 to 10 years, a lot of CEOs, CXOs, and first-time startup founders who've sold their businesses are, becoming very prolific angel investors. So for you, how is, the angel investing or the family office setup, shaping up?
Yeah. So, we do have a family office. I think it was more active when we were in between businesses. I think at a certain point you need to make up your mind whether you're an operator or an investor. It's very hard to wear both hats. I think clearly we've come to the view that we are operators, and of course we do have a responsibility to invest our liquidity wisely. So I wouldn't say we are prolific investors. We invest, generally in very simple products, straightforward products, but we do some angel or private investing as well. And where we do...
Is there a thesis you follow?
Yeah, I have a very simple thesis, right? When I do private investing, I either back an entrepreneur who I know and trust very well, or I invest with a fund who I know and trust very well. Outside of these two, we would not invest privately. And for me, it's very important that wherever we invest, that the founder is willing to take feedback, right? He need not always follow our feedback, but he or she should at least have an open mind to hear our point of view and debate. So we are not hands-off. We won't write a check and disappear, right? I mean, we are not hands-on. As I said, we are operators, not investors. But once you've invested, you do want to see what's happening in the business from time to time, and we are very free and frank with our opinions. So it's important that the founder sees that as a value add. I also think some of this is just paying it forward, right? As a successful entrepreneur, I think that, if there is somebody who's keen to build a serious business and is seeking mentorship, I also feel a responsibility to pay it forward. So, I mean, that's sort of the broad landscape within which we do private investing. But again, as I said, few and far between, very selective. The rest of it is keep it simple.
Right. I think we have just enough time to open the floor for some questions. If any member of the audience would like to ask Mr. Mahansaria. Yes, the gentleman over there.
Hi Yogesh, my name is Saurabh. Thank you for your perspectives, something that we don't get to hear too often. My question is that you spoke about how you are taking a different approach to building business in the 3 innings that you have played. That's from a business model perspective. If we were to look at the same question from the perspective of the type of people and how you are building your team, how you're bringing together your core team as well as the board that you are working with, what differences you see between the 90s, the 2000s and the approach now?
I think that's a very good question, and it's something probably I should have covered when I addressed this. So I think certainly, as an entrepreneur, I try to learn, and in the first journey, it was very much a one-man show, because you're starting off, you don't know how to do things better, and so on and so forth. I think the second time round, I was very fortunate that we had marquee investors along with us who helped me grow personally a lot as a manager, taught me the value of building a sound management team. And probably in the second stint, I would say that process started probably 3 or 4 years after I started the company. And certainly in this go around, it's something I've tried that right from the outset to build a strong management team. That again goes back to the ambition to reach scale faster, to build the business faster. You just need to build a strong, high quality management team from the get-go. Businesses today are too complex to try to manage everything yourself.
And I think it's easier to attract talent having
Absolutely,
seen, yeah.
absolutely.
So that is also.
I think it's certainly easier to attract talent because people can, again, it's a lot easier for people to have confidence in your vision and judgment once you've done it once before.
Right. So I think the session was really enriching. Thank you so much, Yogesh.
Thank you.
Thank you for making time and
My
really
pleasure.
appreciate it.
Thank you for having me over.